Hello, and welcome to another edition of Wealth Management Insights. I'm Lisa Shalett, Chief Investment Officer for Wealth Management, and today's Monday, October 13th, and I'm recording this from my office in Purchase, New York. It's usually easy to characterize markets as either risk on or risk off, but this three-year equity bull market is different because cross-asset correlations have been particularly unusual. For example, gold, the so-called safe haven asset, has been positively correlated with stocks, which goes against the historical norm. In fact, gold is up more than 50% year to date, with an especially eye-catching rally in the past 10 weeks. The positive correlation between gold and stocks has many investors scratching their head, asking what's going on. There are a few theories to explain gold's strength. First, it's possible that gold is being used as a hedge against the risk of a speculative AI-related bubble in stocks. The equity market is in fact expensive and concentrated and in some ways resembles the dot-com bubble in 1999-2000. There's also a case to be made that gold's surge can be attributed to investors buying it as an inflation hedge, especially with the full effect of high U.S. tariffs still to come. A third hypothesis is that investors want to own gold to help offset the risk of dollar debasement. Fears have increased that deglobalization, high U.S. debts and deficits, the threats to Fed independence could lead to global de-dollarization. Central banks in particular have been increasing their holdings of gold and reducing dollars in their reserves this year. We're not convinced, however, that these theories completely explain the current dynamics. As far as the market bubble case goes, consider that gold has moved independently from fear gauges like the VIX and put-call ratios. Also, corporate fundamentals don't seem to be wavering, and while we do see some weakness in the labor market and in manufacturing, U.S. GDP growth has been resilient. Meanwhile, gold has decoupled from inflation expectations. The one-year U.S. dollar inflation swap, usually the best gauge of short-term inflation expectations, has actually been flat since early April, hovering at about 3.2%. Finally, while we have sympathy for the dollar debasement thesis, central banks have been diversifying their reserves away from the dollar for close to a decade, and demand for U.S. dollar assets like treasuries has actually remained strong, including from foreign buyers. So what could be driving the yellow metal? Increasingly, we think that gold's long rally may reflect its own secular growth story. Gold's behavior may be part of a broader global rebalancing amid the ongoing de-dollarization of reserves by central banks and the expectation of a currency market transformation driven by stablecoins, cryptocurrencies, and new digital assets. In a world where fiat currency markets may be remade, one way for select players, including but not limited to sovereign governments, to break in and challenge the U.S. dollar's hold on global money movements may be to improve the collateralization of their fiat currencies or their cryptocurrencies with gold. This could, in fact, enhance their legitimacy. As a consequence, the bull markets in gold and stocks may continue simultaneously. Bull markets are meant to be ridden and not timed, and our foundational advice is to be fully invested according to your strategic asset allocations. Diversification and security selection are, of course, important. Consider squaring portfolios in strategic asset allocation with a focus on asset class diversification. Real assets, municipal bonds, intermediate-term U.S. Treasuries, real estate, and select private infrastructure are our favorite opportunities to add. Preferred equity sectors continue to include the beneficiaries of Gen AI productivity, like financials, healthcare, and energy. Of course, thanks for listening, and for more information on portfolio strategies and financial planning, please reach out to your Morgan Stanley financial advisor.